Thanks, Sean. Good morning, everyone. So, like Sean mentioned, I'll be running through Netflix's third quarter results. We issued our report last week, titled "Gaining Subscriber Momentum." Next slide. Okay, so essentially for Netflix, their results were roughly in line with our expectations. 9 months, 2023 revenue and PATMI came in at 72% and 82% of our 2023 forecast. The main thing from their earnings was actually, paid memberships. Obviously, this number was the biggest performer. Netflix saw almost 9 million new subscribers to its platform for the quarter. And this was the largest addition since the second quarter of 2020. And the largest third quarter addition, the largest addition in any third quarter over the last 6 years. So it's quite significant because there were some sort of concerns over subscriber growth. Because I guess, especially after the pandemic boom, and then in 2021 you had the Ukraine-Russia the war that kind of impacted subscribers, and then since then subscriber numbers haven't really been growing that significantly. But so that's why this is kind of I guess a big positive for the company. In addition to that, why was there so many paid memberships? The biggest reason is because of their paid sharing program, which Netflix actually started almost, I guess, 6 to 9 months ago. So essentially, what this paid sharing program is a crackdown on password sharers and password borrowers. Essentially, it's making it a little bit more difficult for these people to access content and access their accounts. And so we're seeing a kind of a spillover effect where all these borrowers are actually starting to convert into paying users and actually starting to contribute meaningfully to the company's top and bottom lines. The good news about this is that this is expected to continue over the next few quarters because at the end of last year, Netflix actually estimated that about 100 million of its members, or almost half of its members, shared their passwords with other people. So the base in terms of borrowing is very big, and right now they're very early on in this paid sharing initiative. So I expect memberships to continue to grow in the next few quarters, which should in theory lead to greater revenue growth as well because it's all subscription revenue. One of the other things that is quite interesting is that it's actually raising its membership prices for some of its subscription plans in the US, UK, and France. And this just shows more of its pricing power in a lot of these developed countries where it's not afraid of raising prices because they've always I guess mentioned that whenever they raise prices, they always see very minimal churn or very minimal switching from higher price plans to lower price plans. Just continue to show that their pricing power for their products. In terms of the outlook, like I mentioned earlier, fourth quarter revenue growth is expected to accelerate again. This quarter was only 8% year on year, and next quarter is expected to be about 11% year on year. And this is both from more members as well as price hikes. So you have your average revenue per member increasing as well. Margins are expected to be significantly increased. So 13.3% over I guess the prior year was much less than that. It was 7%. And a big reason for this is because of the writer and actor strikes that has kind of led to, I guess, a halt in content spend and content production in Hollywood. And so what we're seeing here is less spend, whereas revenue continues to grow because it's just subscription, right? People are still subscribed to your service, and that's why there's going to be a much larger operating margin for the fourth quarter. Earnings as well is expected to be around $1 billion compared to almost break even a year ago. A year ago in the fourth quarter. Netflix also increased their 2023 free cash flow guidance to $6.5 billion. This is up 1.5 billion. So the previous guidance was only $5 billion. And they also added another $10 billion in its share repurchase authorization. Because as of the end of the third quarter, they only had about $1 billion left in share buybacks. And so, this is a positive, obviously, for investors because it delivers, essentially, it's delivering the company's excess cash back to its investors through buybacks. In terms of our rating for Netflix, we actually upgrade from neutral to an accumulate. We also raised our target price to 455 US dollars. We increased our EBITDA by 3% on higher content amortization. Sorry, I think there's an error here. The previous target price is actually 446, I believe. So we only increased it by about $10. Yeah, but we think that, I guess with the paid sharing initiative working as well as ad revenue starting to contribute a little bit, it's a little bit more promising for Netflix moving forward. They are still the leader in your streaming and your entertainment space. So we expect this to continue moving forward, especially as more people switch from traditional cable TV to streaming preferences. So with that, I'll move on to my next counter, which is Tesla. They also announced their third quarter earnings. And we issued a report this morning with the title Cloudy Outlook on Margins. Next slide, please. So for Tesla, it's kind of the opposite from Netflix in terms of their results for the quarter. This was in line with our expectations, roughly, with 9 months 2023 revenue and PATMI at about 72% and 70% of our full year forecast. The reason why this is a bit low is because most of their revenue and earnings comes from the fourth quarter, which make up usually about 30% of the full year estimates. So it is kind of tracking in line. Deliveries for the quarter came in at 435,000 vehicles, which was a decline quarter on quarter by about 7%. But more or less in line, or rather, it's not really a surprise because in the second quarter, Tesla actually told the investors during the earnings call that they would be shutting down some of their factories just due to upgrading and retooling. And so obviously this would impact efficiency and output. But they did also maintain that they are on track for 1.8 million deliveries for this year, and that's been their target since the beginning of the year. So they are still tracking, and this is quite attainable because essentially if they deliver the same number of cars they delivered in the second quarter, plus about 10,000 vehicles, they hit the target. So very attainable for them. In terms of cost, the cost for them to produce each EV continues to decrease by about 5% year on year, and this is mainly due to lower material and freight costs. In terms of the big negative and something that everyone was harping about was margin compression. So when you look at auto gross margins here in the table, this is excluding regulatory credits. Margins about 16% is down about 10% year on year compared to the third quarter of last year, and this was mainly due to consistent price cuts. I think they had about 6 or 7 price cuts for this year already. Idle factory downtimes, like I mentioned earlier, because of upgrading and retooling, as well as the ramp in their Cybertruck, which is their newest product. And usually, when they ramp a new product, this negatively impacts margins because the ramp up always costs a lot more until they scale to a certain amount, and that's when you start to see margin compression ease off a little bit. The big negative here is that they did mention that the Cybertruck ramp is not expected to be margin accretive for the next at least 12 to 18 months. So this should weigh on margins, at least for the near term, mainly because the Cybertruck is a much more complex product. It's a much more complex vehicle compared to its Model S, Model 3 and Model Y. And also because it's a totally new, I guess, concept. It's not just a sedan or SUV. It's a pickup truck, and so the company expects to see some challenges in ramping up, and so that's why even though it has started deliveries or will deliver in the last quarter of this year, they did also mention that it'd be kind of a negative, at least a headwind in the near term. And that's kind of, in terms of the main outlook, a lot of the call was actually revolving around interest rates. And so what they mentioned was that, due to the higher interest rate environment, this has actually brought up financing costs for a lot of vehicles. And what they've done is actually, and this is one of the biggest reasons why they cut prices, is to make these financing payments or monthly repayments, roughly in line with where it was at the beginning of the year or where it was last year. So they're kind of playing that affordability card for its products, because essentially if they just if they didn't cut any of their prices, their monthly repayments would have gone up maybe 30-40%. Whereas right now, most of them are hovering around where they were 9, 10, 12 months ago. In terms of the longer term, the margin expansion is still expected to come from acceleration in software, which is their full self-driving, as well as some of their fleet-based products. Because these fleet-based products essentially is like your supercharging and some of your services like insurance and all that. And essentially these are much higher, margin products compared to just your EVs. When you look at software margins, usually like 60, 70, 80% gross margins. And then with the superchargers, once they have the infrastructure in place, and once other EV players, start to use their superchargers, then it just kind of expands your margins indefinitely. In terms of the valuation for Tesla, we maintain an accumulate rating, but we actually cut our target price slightly from $265 to $240, mainly because we reduced our 2023 and 2024 EBITDA by 8% and 12% to reflect further margin compression. We have a weighted average cost of capital of 9% and a growth rate of 5%. We still think that Tesla, is well positioned for a lot of growth, at least long-term growth, with them being the leader in the EV space. But we just think that in the near term there is a bit of margin headwind, and that's kind of why we cut our target price. So that's all for Tesla. I'll move on to the FAANGM. So we issued our monthly report on the FAANGM for September. We titled it "Weakness Amidst Higher Rates." Next slide. In terms of overall performance, the FAANGM lagged for the fourth straight month, so it was down 5.7% versus the S&P 500 and Nasdaq down both down about 5%. So not too far away. Metal was the biggest gainer, up 1.5%, and mainly due to some sort of price consolidation after a huge sell-off. At the same time, there was a little bit of buzz around their AI products and their Quest 3, which kind of helped their share price a little bit. In terms of the biggest lagger, and that came from Netflix, and keep in mind that this report came out before earnings. So Netflix was down about 13% in the month of September, mainly due to concerns over tepid ad growth, as well as some sort of vague margin guidance from its CFO, which he actually made during one of conferences that was held with Bank of America. And so I guess investors were spooked a little bit by that, because usually when you ask a question about margins and you don't really get a straight answer, like a lot of investors get a bit concerned as there are a lot more questions than answers regarding this. In terms of evaluations for the FAANGM as a sector, right now the 4P is about one standard deviation away from its 10-year average. So we think that it's definitely looking quite attractive, and we can see this in the next slide, compared to his historical performances. Next slide, please. You can see right now the 4P is hovering about 28 times, so it's close to the green line. You can see it's bounced off this multiple times, and it just goes to show you it is getting a bit more attractive compared to where it was maybe 6 to 12 months ago. Next slide. In terms of the individual news, like I mentioned earlier, for Meta, it was just their Quest 3 VR headset. It's going to be 66% more expensive than the Quest 2, but it's because it has a new Snapdragon chip, which should increase performance as well as display resolutions. But it also unveiled some new generative AI tools and a new generative AI chatbot that got the market, I guess, quite hyped, because essentially, introducing new products, AI products only helps to gives this visual that as a company we are working towards improving our processes using the latest technology, and showing that we are investing in this space and we are not lagging behind. When it comes to Netflix, when it comes to their Quest 3 and some of these AI products, it's good, but it's difficult for us to see in the near term how this will actually contribute to overall revenue growth, because sales for Quest 2 have actually been declining. There hasn't really been much interest in it. So from a financial standpoint, we struggle to see how this would really be a positive for them, at least in the near term. Moving into Netflix, their long-lasting writer strike has finally ended after 5 months. So this has really been a roadblock for production for not just Netflix, or for most major studios in Hollywood. So they finally came to an agreement with these writers with new contracts that included salary increases as well as better protection against the use of AI. One of the big things in terms of their salary increases were bonuses from high performing series or shows on streaming websites, and this was something that they hadn't had before. In terms of streaming's overall share, it dipped a little bit in the month, mainly because kids were returning back to school, as well as there was an increase in TV coverage for the NCAA and NFL football seasons. So it's very in line with historical performances. Moving on to Alphabet, the big thing for Alphabet is a antitrust lawsuit against the U.S. Department of Justice. So it's quite a serious lawsuit. The DOJ actually, essentially is accusing Google of having exclusivity contracts with some of its, either competitors or peers like Apple and Samsung for to cement their monopoly in several markets like Android as well as like Google Maps, because whenever you buy these phones, at least for Samsung phones, Android and Google Map are essentially your default search and default maps programs. And so the DOJ is essentially accusing them of being monopolistic in this sense. Essentially, if the DOJ wins, it could force Google to actually break off its main search business from its other products, and that would be quite detrimental to the company, because then you got a lot of logistics issues, and then it's easier to I guess, or it's more difficult for Alphabet to maybe share some of its data that has worked so well for them in the past. Although we think that this outlook would be quite unlikely, given that most of the other lawsuits that it's faced so far have just ended in fines and not really any major disruptions to business. So that's all for these three counters. I'll move on to my next two counters, which are Apple and Amazon. For Apple, like everyone should know that they launched their iPhone 15 in September. So it comes with your iPhone 15, 15 Plus, Pro, and Pro Max. And there were improvements in some of the performances for their phones, but starting prices were actually unchanged on a like-for-like basis. In terms of initial reports on what was doing well, there were actually reports that iPhone 15 Pro and Pro Max, so the high-end models, were actually gaining, I guess, more interest and more sales compared to just your 15 and 15 Plus. Although it kind of remains to be seen, how, because it's still early days, like how much sales, how well sales are doing. We think that sales should do a little bit better compared to last year, because buying hardware is quite cyclical. Usually there's a 3 to 4 year cycle of your iPhone. So an iPhone 12 was a really popular product. Then I guess after 3 years, people kind of want to want to upgrade their phones, and then they look to buy the new iPhone 15. So we think that sales could be a little bit better than what it was last year. In terms of Amazon, the biggest thing for Amazon was the FTC lawsuit. Similar thing, very alleging that Amazon was violating antitrust laws, blah blah blah. I think it's nothing new for big tech guys. They've been facing lawsuits left, right, and center. And so we think that for this new FTC lawsuit, it shouldn't be too severe as well, given that most of the lawsuits in the past have lasted for quite a while. And the only real, I guess, downside were fines that Amazon actually had to pay to the regulators. And something that we think will most likely happen for this lawsuit. So that's all for the updates for my counters. I'll hand it over to Ambrish to carry on for Microsoft. Thank you.
Thank you, John, and good morning, everyone. So moving on to Microsoft, last month, Microsoft, it had announced a quarterly dividend hike of 10% year over year, which comes to about dividend per share of about 75 cents. And the dividends would be payable on December 14 to shareholders as of record, as on November 16. And just as a side note, among the FAANGMs, Microsoft and Apple are the only two companies that distribute dividends among their shareholders. Moving on to the second point, recently Microsoft, it has completed its acquisition deal with Activision Blizzard after the long review process by the several regulatory authorities globally. So the deal, it mainly closed after the UK regulator, it gave its approval as Microsoft, it was not willing to withhold content, and it had agreed to sell the cloud streaming rights for Activision Blizzard's games to Ubisoft Technologies for a period of 15 years. And after the merger deal, Microsoft it got access to popular games like Call of Duty, Diablo, and it became the third largest gaming company by revenue, behind Tencent and Sony. And sorry, and Microsoft, Activision Blizzard, it had in the last 12 months, it has generated revenue of about $8.7 billion, which comes to about 4% of Microsoft's total revenue. So, in terms of its revenue impact, Microsoft's revenue should see a growth of about 4%. And in terms of its gaming segment revenue, it's expected to get a boost by about 50%, yeah, and which comes to about 24 billion US dollars. And through this acquisition, it's expected that Microsoft it should get a boost for its Xbox consoles, and also it should give a boost to its Game Pass subscription service. And lastly, Microsoft it's expected to post its September ended quarterly results on this Wednesday, and we believe that the results it should post strong results, and it should be driven by a continued demand for its cloud products like Azure and Office 365 productivity software. So overall, we have an accumulate recommendation for Microsoft with a target price of $372. Next slide, please. To conclude, for FAANGM, we maintain our overweight recommendation, and this is mainly because of the continued demand for the digital advertisement as well as crowd products. And secondly, it's also, as mentioned by John earlier, that the FAANGM valuations are attractive right now. However, in the near term, we do believe that the weakness in the tech hardwares like iPhone and personal computer sales, it should still persist. So that's all for FAANGM. I would now like to pass on to Meow Meow.
Thank you, Ambrish. So I attended Keppel REIT's third quarter result briefing. We don't cover the company, so it's not rated. Next slide, please. Yeah. Something about their result briefing is property income increased by 5% year-on-year to 172.6 million, driven by higher portfolio occupancy of 95.9% and positive rental reversion of 10.7% at portfolio level. However, DPU still down 1.1% year-on-year, primarily due to lower associates contributions such as ORQ and MBFC, decreased by around 4%, impacted by a higher financing cost. And this drop was partially offset by the anniversary distribution of 15 million. Gearing as of third quarter 2023 was 39.5%, with all-in interest rate of 2.85%. This is anticipated to increase to mid 3% range in FY24. And we do see picking up in leasing activity in Australia, such as the 8 Chifley Square and KR or Jinza, raising their occupancy rate around 9.7% and 38.2% respectively to 97.1% and 74.5%. And we expect 8 Chifley Square to have full occupancy rate at the end of this year. And also leasing momentum in Singapore market remain healthy. The management is comfortable with some inquiries of downsizing and confident that they can backfill it very fast with higher rental reversion. And we expect rental reversion continue being positive in FY24, but to lower mid-single digit. Singapore market remain robust, with average core CBD grade A office rent increased by 13% to 11.85 square meter per month in third quarter 2023. Yeah, that's all for Keppel REIT. I'll now hand over to Darren. Thank you.
Yeah, thanks, Mariel. Yeah, so for Keppel DC REIT, they announced their third quarter updates last week. So we issued a report titled Waiting for Acquisitions. Yeah, so for their results, it was in line with our expectations for the third quarter. Their gross revenue is up slightly due to contributions from acquisitions and income reversions and escalations, but it's offset by Singapore co-location assets because of higher facilities expenses, and which includes electricity costs. But overall, their distributable income is down 6.5% due to higher finance costs from both refinance loans and as well as the floating rate portion of their loans. As you can see in the chart there, the year-on-year increase in finance costs was a 56.9% increase. Yeah, so for the positives for the update, the portfolio occupancy remained high at about 98.3%. Although it's down slightly, but still to a tenant movement. The portfolio WALE is also at 7.8%, and the thing to keep a lookout for is that 27.7%, which is more than a quarter of their leases by rental income, will expire in the next FY, which is FY24. So the leases that they signed in this quarter were all at positive rental reversions, and we also expect that most likely for the next this 27.7%, mostly co-location assets, we expect that these leases will be signed at positive rental reversions as well. And so for the capital management front, 72% of their debt is on fixed rate, and their cost of debt increased slightly to 2.5% quarter on quarter. And the good thing is that only 4.2% of their debt expires in FY24, which is the next FY, so they don't have many refinancing obligations coming up. And their gearing remains healthy at 37.2%. They also hedge their foreign source income substantially until June 2024 and partially until December 2024. So for their outlook, they have a final payment of 142 million, roughly 142 million upon the completion of this Guangdong Data Center 3, which was originally scheduled for third quarter, which is the previous quarter completion, but it got delayed due to COVID-19 supply chain disruptions. So most likely it will be completed in this quarter, or if it's delayed even further, will be the first quarter of next year. And so when they make this payment, they can fund it by debt. So if they do so, their gearing will still remain below 40% based on our estimates, even if they fully fund it by debt. And they could also possibly do an equity fundraising, but they will only likely do this equity fundraising if they can combine it with acquisition. And the most likely contender for this acquisition would be their sponsors, Keppel DC Singapore 7, the asset which is at Genting Lane, which was completed in the second quarter of 2023 and is currently being fitted out and tested out by the tenants. Yeah, so I understand that recently there's a huge sell down of Keppel DC REIT. We think could be a few reasons. One is the macro factor where the 10-year yields have reached a 15 years high. So because of the 10-year yields high is so high, then the cost of sell down in a lot of the REITs across the broad-based market. But more micro is that Keppel DC REIT, they have their Guangdong data center. They have 3 quantum data centers in Guangdong that are leased out to Neo Telemedia. So this Neo Telemedia, their results for the first half were they announced losses, and then there's some worry that they might not be able to pay their rents. But right now, they have not, rather they have not defaulted yet, and they are still current on all their rental payments. So these quantum data centers, these 3, they account for about 10% of the Keppel DC REIT's revenue. So, but the key thing is that they do not have any intention to that they might be late on their rents, and they are still current on their rents. Yeah, so with that, we upgrade our target price, or rather we upgrade our call from a neutral to a buy, but then our target price we remain unchanged due to the recent share price performance. And more accretive acquisitions and lower than expected interest costs are the catalyst for us. And right now at these prices, Keppel DC REIT is trading at a forward dividend yield of about 5.2% and 5.4% for FY23 and FY24 respectively. Yeah, next slide, please. Yeah, so Keppel Pacific US REIT Core also released their results, and this is a Phillip on the ground. We do not cover them. Yeah, so Core is a US office REIT, and for their third quarter results, their gross revenue increased slightly due to income escalations as well as higher portfolio occupancy, but it's down due to higher finance costs. So it's down 10.7% due to the distributable income is down 10.7% due to higher finance costs. Yep. And for the portfolio occupancy, it's actually increased a quarter on quarter from 90.8% to 91.4% despite the very weak office market. And the physical occupancy right now is at 67%. And with lesser job openings that are remote. So we also expect that this physical occupancy rate to increase, gradually improve over the next year. But right now it's a common thing that the US, most employees are back for 3 days a week. So that is about 60%. Yeah, so for the capital management front, the all-in cost of debt is 4.06%. It increased marginally quarter on quarter, and 76% of the debt is on fixed rate. ICR healthy at 3.3%. And for next year, they have 12.6% of their loans due, but it's towards the tail end of the year, fourth quarter 2024. So this 12.6% due for refinancing. But the good thing is that their lenders are mostly local banks, rather Singaporean banks rather than the US banks, because the US banks are in the US because of the very weak US commercial market. There's some credit crunch going on there, liquidity crunch. That's why it's important that they have local banks to support them. Yeah, and their gearing right now is at 39.1%. So they have about a 15% asset devaluation buffer before their gearing reaches 45% and about 23% for it to reach 50% levels. Yeah, so this quarter they had a positive rental reversions of about 3.8%, and they also noted that there's a continued exodus from gateway cities. So both corporates and individuals are migrating to states with lower taxes, both income and corporate taxes, and the higher level of felony crimes in the gateway cities are also a reason why these corporates and individuals are moving away from there. Yeah, so for the outlook, Core will focus on key growth markets and definitely not in the gateway cities. And the biggest valuation or asset devaluation that we've seen so far mainly are from the gateway cities like New York, New Jersey, and Los Angeles. And for them, Meta, which is their top 10 tenant, Meta is their lease expiry is 2.5 years and is the nearest expiry in their top 10 tenants. So the other top 10 tenants are further, or their lease expiry is longer than 2.5 years. And they also noted that flight to quality remains key, where buildings need to be well amenitized, the design-wise is nice, aesthetics are nice, then the tenants, there's a higher chance for tenants to move in. And yeah, if like grade B and grade C assets, we think there's no way to recover anymore. So it's very important to have good quality grade A assets. Yeah, so for Core, their valuations are trading at 0.25 times price to book, and they're trading at slightly over 20% dividend yield for now. Yeah, so that's all for me. I'll hand over the time to Becky. Thanks.
Thank you, Darren. Good morning. I've talked about Keppel Corp's third quarter results today. Keppel released thank you. Keppel released their third quarter business updates with no financial numbers. So they said 9 months 23 revenue was up 5%. So from there we deduced that for the third quarter of this year, the total revenue fell 6% year on year. That's mainly because it's dragged lower by the weak property sales in China and India. But Keppel did say that the third quarter 23 net profit was higher year on year. But we don't know where, how, or what contributes to that increase. Okay. Just a look at the positives of these results. The third quarter 23 infrastructure revenue, which comprised mainly the integrated power sales, as well as the energy as a service, but mostly it's the power sales in revenue derived from Singapore. That grew 1.3% year on year. It's quite remarkable considering that there is a very volatile gas price movements in the third quarter, and the temporary price control measures came into effect from 1st of July this year. How they could achieve it is also because 100% of its customers on the integrated power sales are really locked in on fixed rates, which means they earn a fixed dollar spread for the sale, or the customers are price plans are indexed to the electric to their cost, and this is fixed for the next 2 years. So it provides stability to 68% of the group's revenue, and Keppel has been able to hedge its fuel input costs for gas, and all costs are passed through to the customers, including the higher carbon taxes that will come through in 2024 and 2026. On the connectivity side, that's mostly coming from driven by M1 and the data centers. M1 has been able to expand its customer base by 7.2% year on year in the third quarter to 2,548. That's also partly because in late 2022 they acquired a Malaysian ICT, so that helps to add on more customers, and also grew their enterprise revenue by 29% year on year. The data centers in Beijing has achieved 100% utilization at end September, so we expect the contribution from this data center as well as the one in Singapore at Genting Lane to start contributing from the following quarters. On the negative front, the real estate third quarter revenue fell 54%. It's a very weak property sentiment in China, despite the weaker mortgage rates. Also, overall, the higher interest rates in other countries has affected their sales in India, and there was zero sales booked in the year so far in Vietnam. The gearing has gone up to 0.89 times, mainly because they disputed the interim dividend. Otherwise, the cash flow looks okay. There's no abnormal surge in accounts receivables. The outlook, we think the asset monetization will gain pace from fourth quarter, with the higher crude prices and stronger day rates for the REIT assets that is held under Asset Co. We think that there's a possibility that Asset Co could be able to divest some of these assets and return. If all these are divested, we could see 4.6 billion return back to Keppel Corp. There's a cash of about $2.50 per Keppel shares. We are upgrading to buy because of the recent price correction. Our target price has been revised to $7.52 from $7.70 earlier. That's because the shareholders have approved the 1 Keppel REIT for 5 Keppel shares distribution. So with that distribution, it returns about 18 cents per Keppel shares to shareholders. Therefore, the target price has to be revised lower to 7.52. Thank you. I'll hand over to Zane for the technicals.
Thanks, Peggy. Morning, everyone. I'll move on to the technicals. So first up will be S&P 500. Last week, after a short period of consolidation at the neckline resistance of the head and shoulders pattern, we actually saw selling take place at the end of last week, and we are currently near a retest of the recent lows as well. So in terms of the whole trend wise, we could see a continuation of the downtrend as there's also a breakdown of this main uptrend channel in the chart. Yeah, so we could see price trade low. The next level of support could be around 4,180 level. So for this week, the resistance would lie probably around 4,300 to about 4,350, while the support could range from as low as 4,100 to about 4,180 area. Yeah, next slide, please. So as for individual counters, the first one will be Palantir. So for this, we had a technical buy at 1736. Take profit levels at $19 and $20 with a stop loss at 1650 and the stop loss goes at 1611. So for this trade, it actually hit our stop loss. The initial trade idea was actually as price was trading an uptrend channel following a breakout of a range consolidation between about $14 or 1630. It could potentially continue uptrend, but however, this has prove to be invalidated, since we actually saw the momentum in terms of the MACD and RSI coming down. Yeah. Next slide. So the next one will be Food Empire. So for this, we had a technical sell at 110. Take profit levels at 104 and 95 cents with a stop loss at 115. The stop loss goes at 107 on Friday. So for this, it had a breakdown of a bearish flag pattern. Also, it has a potential head and shoulders to be forming up. So potentially it could head down towards the first support level at 104, where we test the neckline. Then following which, if we see continuation of the bearish momentum, it could go and test 95 cents, which is the next support level. The weakness in terms of the price is also supported with the downwards trend of the momentum, as you see in the MACD and RSI. Yeah. Next slide, please. Yeah. So this is just a summary of our trades initiated for last week. So we had these two counters, and one thing to note that for Palantir, the stop loss was actually triggered. Yeah. And for Food Empire, the trade is still running. Yeah. So that's all for me now. I'll pass on the time to Paul to talk about Singapore REIT. Thank you.
Thanks, Zane. Next slide. So move on to the usual macro, some of the key macro news that came out last week. So for Singapore, one of it was property sales. So property sales surprisingly was still weak. So especially for new launches, there were only 217 units sold, almost an 80% decline from a year ago. And for the third quarter, it's down about 11%. Year to date, the volumes are still down about 17%. In terms of exports, it's improving from the very weak prior month. So there is some bottoming out happening for exports, in line with what we saw in Korea and Taiwan. There was a slew of news or data coming out from China, but the two main things is that investments is weak, but consumption is still healthy. So for fixed asset investments, so the growth in China the last couple of years, or I mean, probably the last decade, has been all about investments, but this has slowed down significantly to maybe 3%. But what is pulling back is the private sector investments. It's down about 6%. What's holding up is the SOE investments. So the private sector is, I guess, by reading this data, losing confidence in terms of investments. But this is also partly due to the weak property sales. Retail sales is starting to improve again in China. The numbers are very volatile because it's all dependent on pandemic reopening and closure. So it's very hard to see some trend lines. But that's why we said the improvement is due to base effect. But surprisingly, the auto sales in China has been very strong. The auto sales in September was up almost 10%. And this is a record number of motor vehicles sold in a September month, which is like 2.85. So this is a record number. The problem for China, I guess, for the whole economy is the weak property sales. It's down still about 21%, and it's still very sluggish and still declining. We have a chart later. For US, the retail sales was rebounded actually in September and for the whole of third quarter. Things that the consumers are spending is still food and services, restaurants and so forth, and healthcare. Electronics is still weak, and general merchandise is moving sideways at 2%. There was a Fed speak again. There was Jerome Powell had an interview. So some of the key things he mentioned was that the rising bond yields that we are seeing in all over the headlines is clearly tightening of financial conditions. And it could substitute the Fed rate increase at the margin. Obviously, he cannot say completely, but I guess it's an indication that the bond markets are actually doing the tightening for the Fed. The other comment was just that rates haven't been high enough for long enough. I guess just a reminder that he thinks rates need to be higher for longer, I guess. Next slide. Okay, in terms of our tactical views, I think the main headlines has been the 16-year high in terms of the US 10-year US Treasury bond yields. So I'm not the credit analyst, but let me just share what's my view. So one of the reasons why bond yields are so high in the US is, of course, the deficit in the US. So the fiscal deficit means the government spending more than the revenue actually rose by 1 trillion extra to 2 trillion. You notice some of the numbers might be 1.7 trillion deficit, but because there was a bit of they added back something in, which is the student repayment. I don't go too detailed in it, but the real number is about 1 trillion increase in deficit. And that boosted the US GDP the past 12 months by almost 4%. And if you think the US is growing maybe 6 to 7% nominal GDP plus, so half of the growth in the US is roughly coming from the government spending. It was especially acute the last 4 months. So of this 1 trillion, the deficit, most of it came about the last 4 months. So as a result of that, the issuance of bond or debt by the US government surged up a lot by 900 billion. Then plus then point number 3 plus quantitative tightening, which is the Federal Reserve selling bonds into the market. The amount of bonds that's had to be absorbed by the public or by the market actually rose by almost 1.7 trillion the last 4 months. No, this compares to almost only 400 billion a year ago. So there was just a huge amount of supply of bonds that came out. And of course, the other reason is the higher for longer since the FOMC meeting on the 20th of September. They raised their interest rate expectations, and of course, the market also rightwise. A more technical thing is also the higher real interest rates, because what it means is that interest rates are now in real terms. I mean, after inflation is still high, and the Federal Reserve wants that because they don't see the high interest rates affecting the real economy. I know that's very confusing, but anyway, one way to calculate what is roughly the fair value of a 10-year bond, which is roughly about 4.5%, is what you do is that assuming the Fed hits its target of 2% inflation, then you add in the real rates. That means you need to earn some real returns, which historically has been 1.5%. Then you add in 1% term premium. That means the Fed funds to the 10-year. I know all this is very complicated, but anyway, if you want to have a guess where the 10-year bond yield should be, it should be roughly 4.5%. The interesting thing is that when the fiscal deficit surge, it's actually very good for equities because earnings will grow, the economy will grow, and it's actually negative for bonds. As what we mean is that the bond prices will drop and then yields will climb up, as we see right now, the bond yields or bond interest rate climb up. And it is the problem now is it has jumped up so much that it is actually now affecting equities. Again, this is a very long answer as to why the bond yields are up. But we do find these bonds attractive, I think, because what we think is that, like we mentioned earlier, the Fed has really commented that financial conditions are tightened. So the rising bond yields has actually tightened, is doing the job of the Fed. So they're less likely to raise rates in the next 2 more meetings this year. And we still think that the US fiscal deficit will come down, which will also cause the economy to contract. That means one is of course the Social Security. I think we highlighted in our 3rd quarter presentation. That will drop by 100 billion Social Security. And then one anomaly why the deficit is so high is that in California, the biggest state, they actually delayed their taxes from April to November. So this, the numbers, they don't have the real exact numbers, but this could have delayed revenue collection by almost 300 to 400 billion. And of course, that's going to stimulate the economy because people don't have to pay tax. Obviously, they're probably going to spend it. So we think this will claw back in the coming months. And of course, the usual thing, we think slower growth because there's student debt repayment, interest rates are higher and longer now, and then of course there's falling excess savings. All this we discussed in our 3rd quarter. In terms of events, there's a lot of events coming up this week. There's Microsoft, Google. For Singapore, there's a UOB Bank results coming out on Thursday. The important one, of course, on Friday will be the core PCE, which is the Fed's inflation gauge. And then from November onwards, we have quite a number of REITs, including Manulife REITs, SU, Keppel, and ESR. If you do have time, feel free to register. It's open for everyone. Next slide. I'll move on to just some illustration of the deficit. So the blue bar here is the deficit. That means how much the government spend and how much they collect. So deficit means they, like 2020 was 3.3 trillion, mainly because the pandemic. Right now they are trending at almost 2.7 trillion, and this is like almost 3 times more than the deficit they faced the pre-pandemic. So it is not about the corporates growing, it's all about the government spending money. So like the title suggests, we highlighted, no, fiscal deficit positive for equities, negative for bonds, but now it's creeping back into hurting equities because it climbed up too much. And this, all this is just for your info. I mean, move on to the next slide. Then the supply of treasuries also spiked together with the quantity. So the last 4 months was especially sharp. The last 4 months, the amount of bonds being issued, either new bonds or the Federal Reserve selling bonds in the market. So this is government bond debt holdings held by the public. That means the market, non-government. So this one you can see the beige bar. You can see this very sharp spike here. And when it rises, then interest rates will also climb up, which is the blue bar. It didn't climb, the blue bar, the blue line didn't climb as much as the beige bar because this was during pandemic and US Treasuries was a safe haven. But right now, it is climbing, which it should, in line with the amount of new supply coming in. Again, this is just a calendar computation of the chart on the left. Next slide. So this just to show you that in China, in the past, you look at during the good days of China during 2010 or 2009, you can see the blue line where fixed asset investments was trailing as much as 30%. So this was where China got a lot of the growth from investments, but this has started to come down. So the beige bar, which is the private enterprise, is the one so the private sector is not investing. Maybe because of what happened to the internet sector, I'm not sure, and their confidence is weak and property sales so weak. So, but the SOE is the one that's holding up. And also for the property sector, the red line, it used to be these are new home sales in China. The red line used to be as much as 15 million. Then now it's down to 9 million. This is a very huge consequences for the Chinese economy because like we highlighted before, upstream so there are 3 parts to it. Upstream you have the commodities, copper, cement. Then downstream you have electrical goods, furniture. And the third part is also local government finances will be affected because they cannot sell more land because there's not enough homes sold. So this has quite a huge multiplier effect to the Chinese economy. Next slide. Then the last one, before I move on to fear of ground, but surprisingly, they are spending on cars. So consumer spending is actually doing well. You see the blue line here, which is the calendar. So the red line is the car sold in 2022. Then the 2019, I just wanted to use it pre-pandemic. So the car sold now is even higher than pre-pandemic levels. I'm not sure what's the reason. Maybe partly because of EV. I'm not particularly sure, but it's a record number. The one on the right is just to show that the US retail sales has actually rebounded surprisingly in the third quarter. So the third quarter GDP read for the US should actually be still strong. Next slide. Okay, I'll just run down to the Phillip on the ground. We don't cover the stocks, but because we attended analyst briefings, which the most do not get access to, so we'll just try to explain to everyone what was the key message in the briefing. So this is the upcoming NIX professional IPO. So NIX is a small cap, only 30 million. So they have 5 doctors and then 3 clinics and 3 salons. I guess one way to understand, like the title suggests, they are basically GPs or general practitioners with postgraduate qualification in dermatology. So I don't think they're dermatologists, but they got postgraduate. So they're basically GPs selling beauty products. I mean, that's a summary of what the company does. They make like almost 3 million, and the revenue the profit seems to be very stable because these are skincare products that they do, and obviously skincare has super high margins. So in a way, this is in our final comment is that they're basically using GPs as a distribution channel to sell skincare products. I think nothing wrong with that, and it seems to be very effective. The most interesting thing for me, apart from the model, is that they have a very small public float, which could help the share price because there's only 1 million of new shares. So you look at the offering stats, 1 million public offer. So most of it is placement, and there's very little float in public hands. I guess this is going to be helpful for the shares. Share price. Next slide. The next is just there was an analyst briefing last Monday on Aztec Global. So Aztec Global is a contract manufacturer. Like your value, like your venture and so forth. The earnings was flat the headline was strong. If you look at the table on the left, net profit is up almost 48%. But because third quarter last year, there was a 15 million hedging loss. Okay, so obviously they did something very interesting with their hedging. The other thing is the order book is down by almost half. But what they did say is that they're not particularly worried because with supply chain normalizing, the customers don't need to really order so much. And they also said that maybe 80-90% of their order book 80 or 90% of the order book should be completed by FY23. So this implies that the fourth quarter revenue should still be strong. You're talking about maybe 4 to 17%. Okay, so if I go down to the comment, I think they are trading at 6 to 7 times PE and they got 195 million cash. And one unique thing about them right now is they're one of the very few electronic companies is going to cross 100 million net profit. But the one risk that investors take, I guess, if you buy into this stock, is just that they're very reliant on a single customer. So 85% of their revenue, which I think you should assume 90% of the profit will come from just one single customer, which we think is going to be Blink, which is part of Amazon that sells surveillance cameras. And the growth for this customer will still go because they are still expanding. There are new products from this customer, and also this customer is going to expand into Europe and so forth. But the valuations are very cheap at 6 to 7 times, and they even have a 200 million of cash. Next slide. Okay, I think that's it for me.
Yep, thanks. Let me answer some questions. Keppel DC REIT, please comment on the sell down. Yeah, so after their results, Keppel DC REIT, they've been being sold down like 3% each day, and then it only rebounded quite sharply this today. But today's rebound is more broadly in line with the rest of the market. And I think I mentioned a bit about why Keppel DC REIT was sold down earlier in the presentation, probably because of the new telemedia they came out with their results for the first half they made losses. Because of that, there's some worry and some jitters that they might not be able to pay the rental for their Guangdong data center leases. But right now, still Keppel DC REIT, they came out and said that there's no issue there. They're still current on their rents, and they do not have any intention of not paying or any delay in the lease here. So for that, there's no immediate issue there for now. And of course, the rest of the REITs, we saw a huge sell down, mainly because of the 16-year high or 10-year yields usually is inversely correlated. Like the yields are so high, usually REITs will sell down because it's inversely related to interest rates most of the time. Yeah. There's a TA question on Keppel DC REIT. I'll leave that to Zane. Keppel DC and Ascendas up this morning views, please. Yeah, I would say that it's not so much just these two REITs. Like I take a look at the broader market, all of the REITs, or rather most of the REITs are up today. My personal view is because it was oversold when the yield spiked last week. So because of that, there's a bit of a rebound this today. Because it was likely oversold last Friday, especially. So as a result, most of the REITs are up today. Prime has been dropping, but dividend payout is more than 50%. When is the next dividend payout, and are they in trouble? Yeah, so for Prime, yeah, you are right that their dividend payout is very high, and I'm not sure whether it's that high, 50%, but their next dividend payout, they usually pay out every half yearly, so it will be they just paid out their first half dividends, so you have to wait until the next year usually after their results, and then probably they'll pay out around March. And the next part of the question is, are they in trouble? Yeah, so for Prime, we keep a lookout for two main metrics for them. One is the asset devaluation that will affect gearing. So right now they have about a 5% buffer before it hits 45% gearing and about 15% before it hits 50% gearing. So for that, we are on the lookout for the asset evaluation. And another one is the next refinancing that they need to do in June 2024. So that accounts for about 60% of their loans. So if they are able to refinance these loans, and if they are gearing, or rather their asset devaluation doesn't hurt them that much as to force Prime to breach their gearing levels, like both the MAS covenants and the bank covenants, then Prime wouldn't be in trouble. But we have to keep a lookout on these two factors. Yeah, but as of now, yeah, they're still paying dividends and they have not halted their dividend payments. ESR REIT has divested 2 properties. Are they paying out dividends from these sales? And what's the share price dropping? Is it time to buy as I'm looking for dividend stock? Yeah, so yeah, they divested a couple of properties and they did not indicate whether they'll use to pay dividends from these sales, but in this current market, most of the divestments that companies do, they'll just use to pay off the existing loans, especially the loans that are on highest interest rates in their books. Yeah, so from that they will likely get a lower overall finance cost. So yeah, that's the strategy. So yeah, why is the share price dropping? Yeah, I would just think it's the Fed stance where they came out and said after the 20th September meeting, the higher for longer. So this higher for longer really hurt all the REITs. After that, most of the REITs really got sold down after this stance. Yeah, we have to monitor the refinancing schedules. When refinancing is done, the DPU will drop because the finance costs will definitely increase. Is this assumption correct? Yeah, so in this current market, yeah, correct, because back then when the loans were originally done, the interest rates were definitely not at these high levels. So now when the interest rates are so high, then when the REITs refinance the loans, they'll refinance at a higher rate as well. So that will definitely affect the finance costs. So in this current condition, the finance cost will definitely increase because interest rates are higher now as compared to when the loans were initially drawn up. So yeah, correct when you say in these current conditions. And how do floating rate loans affect financing costs? Yeah, so I think I can use an example to explain this. Like maybe when you get a house when you buy a house, then you get a loan from, let's say, the HDB, the 2.6% rate, right? So that's a fixed rate. And as compared to when you get a floating rate loan on your mortgage from the banks. So from that, you see every month, if you take the HDB loan, you're just paying a fixed amount. But then when you take floating, your interest rates will keep fluctuating depending on the interest rates. So right now, because the interest rates have risen by almost 500 basis points since last year, so the floating rate, you've been paying more interest basically every time the interest rates increase. So as a result, your floating rate will keep increasing, and your finance costs on these loans will keep increasing as well. Yeah, so that's how the floating rate loans will affect the financing costs. And in this current macro conditions here, your floating rate, as the floating rate increases, your finance costs will also increase, and it's by quite a big margin. Yeah, especially since the 500 basis points increase over the past 2 years. United Hampshire REIT, when's the next dividend payout? Yeah, United Hampshire, they also pay out a half yearly dividend, and whether it's a good time to buy, yeah, we do not cover, but if you're looking at a technical standpoint, I'll leave that to Zain as well. Yeah, thanks, Zain. Singapore SORA does not seem to be increasing anymore. Thus, can we say that REITs with Singapore assets will not have higher financing costs moving forward? Financing costs will remain at current levels after refinancing from earlier interest rate levels. Can we say this? Yeah, so usually when interest rates are low, the bank margin that they demand from all these loans are also lower. So when let's say the SORA increases, right, then the banks sometimes, rather a lot of the time, they'll demand a higher margin as well. So usually when when the REITs refinance, because now the margins are higher, the bank margins are higher, yeah, we expect the rates to increase.
There might be higher because they are refinancing from 3 to 4 years ago, right?
Oh yeah. That's also a good point. Like back then, 3 to 4 years ago, the especially during COVID, the rates were 0, and then now the Fed rate is 5.5. So yeah, you can expect a huge spike in the rate. So financing costs will remain at current levels after refinancing. Yeah, so the financing cost will still increase. Yeah, because the rates are still increasing and probably peaked, but yeah, it's still much higher than back then. Please comment on CapitaLand. Yeah, I'm not sure which CapitaLand talking about, and FCT. Yeah, so FCT, their results they'll be releasing in a few days' time. So yeah, FCT, they've been doing some good asset recycling. They divested their Chinese City Point, which is I would say is not part of, it's not their core asset because it's more of an outlet mall rather than your classic suburban mall. And then yeah, they use this divestment to pay off the highest interest, the loan with the highest interest rate. Yeah, so and then FCTs, they are also they are resilient because of their they focus on essential services. About 55% of their tenants on essential services, and for them their occupancy cost is also much lower than their average. It's now about 15% or even lower, and the average is about 17 to 18%. So that gives them some room for positive rental reversions going forward as well. Yeah, we have a buy call on FCT with a target price of $2.35. For core, do you foresee any possibilities of it not being able to pay dividends in the near term? A more than 20% dividend yield plus 0.3 times price book. Is it too hard to be true? What's the catch? Yeah, so for core, because of they're affected by sentiment mainly. I mean, the market is also weak, but we need to think whether we need to question ourselves whether the discount that the market is giving to these companies like Core, Prime, etc., Manulife, is the US market really that bad? Yeah, but so for Core, right, their gearing levels are still healthy. Like I think I mentioned earlier in the slides, they still have quite a decent buffer for asset devaluation before their gearing breaches the MAS limit. So yeah, I do not see them not being able to pay dividends because they do have a good buffer in their gearing levels. Yeah, but then for the US office REITs, we think that any solid recovery will come towards the later end of 2024 and 2025. Yeah, so the sentiment is still weak, but yeah, we think the recovery will come then, the later tail end of 2024. Okay, I think that's all. I'll hand over the rest of my time to my colleagues. Yeah, thanks.
Okay, maybe I take over from here. Thanks, Darren. Okay, there's a question on C-Stream. C-Stream is performing badly last week. Do we have any new updates? How realistic is the risk of further rights issue? Yeah, there's no updates on C-Stream except that they deliver some vessels, but it's nothing that can move the needle. The concern right now is really the situation in Middle East. because Seatrium's orders come mainly from the Europeans and Middle Eastern customers. The situation in Middle East might cause a disruption to the oil production as well as transportation, which will means that there could be delays in capital expenditure decision or even potential deferment of orders. So as an equipment provider, as a upstream equipment maker and manufacturer, it's not conducive for them at this point in time. This is all I could say. I can't tell if there is going to be a rights issue. I hope not. I pray really hard for it because technically we already have 3 rounds. 3 is really too much for any companies over 3 years. So sorry, I can't comment on that, but they promised to give us a review of their operational review by the end of this year to see how they merge after the merger with KOM. How are they going to improve their overall organizational structure? Yeah, so we are waiting for that to be announced anytime soon. Thank you. The next question is I see a question on Keppel, I think. Okay. See, what is the prospects of Keppel's land bank? Any idea what is the size and value? Okay. Keppel land banks are mainly, Keppel has about 39,000 units of residential land bank, mainly located in China, Vietnam, Indonesia, India, in that order. So China is about 43% of this total, of the 43% of the 39,000 units. Then on the commercial side, they have about 1.7 million square meters of gross floor area of commercial units. So according to RNAV, my estimate is about 5.6 billion Sing dollars worth for these 2 land banks, total land bank combined. This is about 43% of Keppel's RNAV. So there's 5.6 billion of value of the real estate. But I think this 5.6 billion is more nearer to the cost price of the land bank. So therefore, I think I'm on the conservative side. I think the market has a higher valuation for it. My estimate is more towards the cost value, the cost that they incurred. So I'm not factoring any development potential or profit. So I think I'm conservative in this area. But of course, because of the high interest rates, this 39,000 units might find it they might take a little bit longer for them to sell it, or the potential is also for them to inject these units into if they raise a fund, they can seed the fund with these units, and then the fund together with third-party partners might develop the units, and therefore they might not need to be selling it to the market. They might be seeding these assets into the fund. So that is also another possibility for them to realize the value of the real estate. Thank you. This question is, hi Peggy, last week you mentioned something about China Aviation. What is their latest financial standing and prospect going forward? Things look positive for them. Going by the traffic volume and data from China Eastern, China Southern, and China, all these are booking very high traffic and forward sales for their tickets. So which means the jet fuel consumption is likely to be coming back very strongly in China. And China Aviation is a supplies source and supplies the physical jet fuel into the major China airports, and in China, Pudong, they are also like acting like a petrol pump for all the flights, international flights that are flying out of the China Pudong airport. So it's positive, but I think I can only get my numbers out by maybe in the next 2 days. And then I'll provide more update further down within the next few weeks. Yeah. Thank you. I saw another one. There's a question on Keppel distribution of the Keppel REIT. After the in-specie distribution by Keppel Corp for Keppel REIT, do you expect the price drop, and what do you recommend to hold or sell or add? Yes, Keppel is distributing 1 Keppel REIT shares, which they are holding, for every 5 Keppel shares held by the Keppel shareholders. So this calculate, if you put into value, is about 18 cents per Keppel share. So we expect the price to correct by that value. I think you are asking whether to recommend to hold or sell or buy the Keppel REIT. I think the most Keppel shareholders might treat this as a special dividend. So we think there could be, in the near term, could be an overhang on Keppel REIT share price. Thank you. I think another question for me is the rising interest rate environment affecting SC Engineering in any way? Definitely, I think mainly because of their gearing levels is about 2.2 times. I think I remember it's about 2.2 times net gearing for them. So it does have an impact on their interest expense, but being ST having a strong parentage just help. So ST Engineering thinks that the interest rates, effective interest rate that they pay will only be likely to be mid 3% in 2024. So it's not going to be a significant increase in the rates, but yeah. So the impact on ST Engineering is probably less compared to the others companies or their corporates on the Singapore market. Thank you. I think I will hand over to the others. Thank you very much.
Thanks, Becky. There's one question here on Tesla. Why is Tesla truck more complicated? Yeah, so it's more complicated from from engineering and manufacturing perspective. Because first of all, it's newer technologies. There's more wiring, more complex wiring involved. Secondly, just the shape of it is very different from a lot of cars. So when it comes to manufacturing, some of the parts like the glass panels are very big, very difficult to manufacture. At the same time, there's a lot of large flat square pieces or just large flat pieces in general, which are a bit more difficult to actually manufacture as well as assemble. So a lot of the complications come from the design of the vehicle in manufacturing rather than, let's say, from a software perspective. And so right now, because Tesla is just initially, I guess, in the initial phases of scaling, building out the truck, they're kind of encountering some problems, which is expected with like every other build-up. It's just that given it's a very different product from what it's used to, it's just naturally going to be a bit more complications. That helps to answer your questions.
Yeah, okay. I'll just take some, then we'll hand it on to Meow, you want to?
Yeah, I just take the Keppel REIT question. Sorry, let me find it. Yeah, for Keppel REIT, what does the NPI attribute put to non-controlling interest mean? So like non-controlling interest is just the minority interest. it represents the share of NPI of the subsidiary company that is attributable to the investor who is not part of the Keppel REIT. Yeah, so company like with greater than 50% of the ownership but below than 100% is required to do the full consolidation. Like they'll just incorporate 100% of the subsidiaries financial to their own financial statement. Like for Keppel REIT, Ocean Financial Center 6 and T Tower 7 and KR Jinza is under that category, greater than 50% but below 100%. Yeah, so net property income will be fully consolidated into the P&L under the NPI first, and then subtract the interest that doesn't belong to Keppel REIT. Yeah, for example, they own 79.9% of Ocean Financial Center. Yeah, so NPI will be fully added, and then they'll subtract 20.1% of the NPI afterwards. Yeah, hope it answers your question. I'll hand over back to Paul. Thank you.
Yeah, thanks, Mel. Let me just try to answer a few before we hit 12:30, then we pass it on to Zane. Paul, do you see counters like SIA, Ascott, Genting, etc. will continue to gain from influx of tourists to Singapore, year-end holidays? Yeah, I think if you want a pure play among the three, it would be Genting, because Ascott, maybe Singapore is only 20+% of their portfolio. For Genting, I didn't do a slide because I didn't have the time, but if you look at Marina Bay, Las Vegas Sands, when they announced their results, they did share some of the stats for Marina Bay Sands, and for the third quarter continues to be strong. So their mass market, that means people like us go gambling, because slot machine and table is up about 30+%. And their VIP, you know, the rolling chip is also up about 20%. So third quarter should still be strong for Genting. For hospitality, for pure Singapore place would be maybe like something like Far East Hospitality, something pure play, because like Ascott is still diluted by other countries, which of course still doing well, but if you want something that, at least something that we can identify clearer, because of the rising tourism. Okay, any comments on the recent and future outlook for UMS, Franken and AEM? I'm a bit cautious. I think do know that I think it's going to be a period of consolidation for them. Do know that like someone like UMS and most of these stocks didn't really drop much this year. Some actually went up, number one. And number two, in terms of earnings, they actually grown a lot the last 2 years. These are record levels. So I don't think they can grow further at these levels. I think it was going to be another week, at least 2 or 3 quarters. Then maybe second half, there's some outlook. Because right now, semiconductor demand is only coming from AI. And from, like we mentioned before, no, all the Chinese equipment, I mean, all the Chinese are buying and stock and hoarding semiconductor equipment because they're worried they can't get access to it anymore. But these are the only source of demand. So I think it's still going to be weak, and maybe only in the second half you could see some recovery. Yeah, it should be improving because customers are replenishing their inventory. But I think to grow again, it's going to take some time. So I think it's just going to be consolidating until maybe hopefully second half of next year. But even then, also not that optimistic. But anyway, that's the outlook for now. What challenges is Netflix facing, and at what price? Netlink, sorry, not Netflix. Netlink is basically in the near term. So those who don't know, Netlink is they are the fiber connection. All of us pay Netlink, I think $13 plus for connection to the broadband. There's a review underway. The review whether to raise or decrease the price. So that should be announcing very soon. Well, they keep on saying very soon, but so that's the one challenge or uncertainty, I guess. What price would it be a buy? I don't think it's a REIT proxy. I would rather buy a REIT than a Netlink, mainly because there are underlying assets behind it. Because for Netlink, the value of the assets, of course, right now for REITs, the value of property is all declining. But you think longer term, the value of the assets should be rising. But for Netlink, I think the assets, I'm not sure, the fiber connections, we can see that the value is climbing up every year. So that's one difference. Of course, it's also a business trust. So if you want to compare to the REIT, NetLink is a business trust. So they may not actually pay out from their real cash flows, because some of it can, for a business trust, you can pay distribution out of borrowings. Of course, you so the offset is the capex. So I think NetLink is still fine, but 2026 is going to be a big issue, a big problem for them, because most of the debt has been hedged to 2026. So when that happens, and if interest rates don't come down, I think the dividend is going to take quite a bit of a knock. It can be quite, because they refinance their 80% or 70% of their bank loans at I think 1% plus. Obviously, that's not going to continue if you hit 2026. So that for me is the biggest challenge for them. But for next 2 years, I think should be still fine. Not that we have such a long-term perspective anyway. Yeah. Okay. Let me quickly run through. In terms of Raffles Medical, there were a few questions on Raffles Medical. How is Raffles Medical doing in China? Any update? Do you see stronger results this year compared? And what's your take on Raffles Medical? Almost definitely, I don't think they can repeat the results for last year. So for Raffles Medical, they're going to be dragged down by number one, there was still some pandemic-related vaccination and testing, so that's going to be hurt for that. But the big impact is also from the transitional care facility. These are basically temporary hospitals to help the government hospitals that have too many patients. There was a latest round of bidding, and I think they don't disclose, but I think they probably got their margins going to be hurt quite tremendously by the new bid activity, because these are government projects. So you have to keep on bidding, and I think the latest round of bid they secured at 150,000. Whereas most of everyone else was about 400,000. So I'm not sure like how special their cost is. So I think the earnings, we expect the earnings to be weak as we approach the second half. For China, they don't really give any updates. But I think for China, you probably need to take like a 5-year view, because it's still going to be loss-making the next 1 to 2 years to scale up. But the one thing going for Raffles Medical is that I think the valuations now is probably mid-teens or maybe 20 times PE, which is actually very cheap, because private transactions are going about 50 times PE, because hospitals are really rare, especially in Singapore. They don't issue, there isn't many new private hospitals. So there's a valuation upside to it, but operationally, I think it's just going to be big. I'll answer one more, then I think any update on Q&M price continues to. Yeah, I think for Q&M this year is really they expanded very aggressively, as you recall. I think they opened like 20-30 new clinics, or 20-30% more. But the utilization rate has been weaker than expected. So they are actually now not expanding clinics. They are just they are still growing the number of doctors, dentists. So that's the positive. It's just that they need to fill up the chairs more. They need to raise the utilization. So this thing will probably, you only see the fruits of it maybe 2024. So that's why operationally they have been weak. Okay, one last, since you got time. On venture, looks like it's underperforming most of the peers. Why is that? Actually, venture has been underperforming since I think 2018. Since 2018, venture has not been able to hit record. Since the record revenue in 2018, it continued to be sliding down. Then last year there's a bit of bump. They just not been able to secure any new major customers. They are relying a lot on medical, but that has been disappointing. Some of these new products. So they don't really disclose much things, but the only thing I can say is just that they got no new programs, which is probably obvious. Especially if they are based in Malaysia and you still cannot get any new customers. I think the competition is probably getting more intensive for them. Yeah. So, really not much to say, because they don't really disclose, and if you ask them why are they underperforming, they probably scream at me. Yeah, so not much disclosure from them anyway. Okay, I think we can move on to Zain.
Yeah. Before Zain, is it possible I can answer one question? So the question is, with super high 10-year USD bond yields, should we expect coming months SSB or even CPF OA to spike even further? So I'm not really that sure about for CPF OA, but for SSB, yes, it is possible because our SSB tracks on the average 10 yield of SGS bonds, and our SGS bonds has a slight correlation with our with the 10-year USD bond yields as well, but not entirely. However, do note that because our MAS manages our country's interest rates in the economy differently from the US side. So because our MAS manages the interest rates through the exchange rate policy. Yeah. So I mean our current 10-year SGS yields are trading around 3.3 to 3.5 range. And I think with the latest SSB yields, which gives us I think 3.32% yield if you were to hold it for 10 years. So I mean this shows that there's a spread of approximately 100 basis points before reaching the average yield for the 10 years. So I mean, do note that the latest SSB will be closing this Thursday on the 26th of this month. Then also for SSB, there's a maximum limit that one is able to hold up, which is 200,000 for each investors. So I mean, if you're interested in SSB for its flexibility and would like to park some of the funds in it, then yeah, you are able to do so in this window. But perhaps maybe you like to space it out for this window. Maybe you put some of your funds inside, then for the rest of the dry powder, you can put it in subsequent windows as well for the rising yield. Yeah, that's all I have. Thanks.
Okay, thanks, Sean. I'll start with the technicals. So first up will be CapitaLand Escort Trust. Price looks like we currently touched these downtrend channels over here. That's around the 86 cents level. So in terms of momentum wise, there's no confirmation yet that we could be seeing a bounce soon. But at this level, there's also a previous support level formed in November of last year. So if it's able to hold, perhaps we could see some sort of sideways trading for now. There's still expected to be resistance near 88.5 cents, which was this support level that we actually broke down off. Yeah. Then the next one will be Agricultural Bank of China, 1288. Yeah. So for Agricultural Bank of China, we had a pullback after we retested this $3 level. Then currently we actually retested this uptrend channel over here, the support. So for the uptrend to continue, this is a key area. We need to see price bounce off from this level and try to reclaim this 292 level upwards. Yeah, if not, there could be some further pullback downwards towards the next strong support. This is around 270, close about 272, 273 over here. Yeah, but for now, it's still in an uptrend. Just need to see how the price reacts at this level. Okay, next one is Link REIT 823. Okay, so for Link REIT, price is still trending downwards. Could be actually just still trading within this channel itself. Yeah, so in terms of next support wise, around $35, there's some support in the past. So it was way back. This was way back in 2016, I guess. It was a previous resistance level over here, 2015, 2016. Yeah, so at this level, there could be some support acting for Link REIT. See whether there's some bounce could come. But I think near-term upside should be still pretty capped since there was quite a period of range consolidation. Actually, price made a lower low. So expect to see resistance around 36 to about 37. There's expected still some resistance over here. Okay, next up, here for STI. Okay, the STI is trending downwards after we actually broke down this key trend line over here. Just mark it in blue. Yeah, so this has been the key trend line that price actually supported from, and then yeah, last week we actually had a breakdown over here, and we saw price just fell, came lower. So for now we actually broke the one support level at the 3,100 level. So I think for STI we could see further pullback towards the lower support level, close to about 3040. Yeah, that was like some key support level back 2021. Yeah. Then interestingly, for now, what we're seeing is it looks similar to what we had last year. So last year during we had SCI had a huge pullback from the middle of September until the end of October before we saw a rebound. Yeah, then interestingly, we are seeing something similar take place over here. So for now, I think we could still have some pullback, and to see when we could rebound, I think we still need some confirmation signals. Yeah, but interestingly, when you look at the RSI, that's an observation that I made. And interestingly, the RSI was hit about 22. For STI, it proved to be quite a strong support points in the past 3 times. So if we do hit those levels, then I think that we could have some sort of a stronger rebound. But for now, likely the downside momentum is still pretty much intact. Okay, then next up for Keppel Corp, I think Keppel Corp is still trading in this downwards channel over here. Price managed to find some support at this area, which was around 615, I think. Yeah, 615 over here. So for now, we could see some sort of a bounce take place. But I expect to see resistance still upon retest of close to about 645 to about 655 area, which is this zone over here. Okay, then for Semicon Industries, price is possibly consolidation, trending in this descending wedge pattern over here. Price has started to hold around 453, which was previous this range support level. This was back in May this year. Yeah, so if this holds, perhaps you could see maybe price just sideways over here for a while, with resistance close to about 470. Yeah. Okay, the next one, Mapletree Logistics Trust. Okay, I think for now it's at one support level. But the trend wise, I think we are still seeing quite a strong downtrend in terms of the momentum. And from the charting point of view, after you broke down this consolidation triangle, okay, there was a retest and price made a lower low. Currently, we are right around 149, 150. This range support level, which was at the end of last year. So at this level, maybe we could see some price try to sideways a bit if some support decides to come in. But if it doesn't, then we could possibly see maybe price trade lower. To the next strong support level could be around close to about 140. Yeah. Okay, then there's a question: what's a safer price level to buy Keppel DC REITs from a TA perspective? Okay, so for Keppel DC, there was a very strong sell down. I think it was down about 15% for last week. Currently, there's still no confirmation signals for a very strong bounce, but I think price rebounded today. I think just because it was pretty oversold. We hit about 17 on the RSI. Yeah, and currently we are retesting about 182, which was this previous key level, previous resistance level end of last year. So I think for Keppel DC, for safe price to buy, I think what I will be watching for is one thing is if it makes a lower low, then on the next support level we are close to 167. Then I will want to see some sort of bullish divergence take place in terms of the indicators. And if another scenario take place would be, let's say price decides to pull back, but it doesn't break below the recent lows, and that we have a higher low formation, then I think you can look to enter a trade possibly. Then if you have a stop loss in mind for a breakdown of the low. Yeah, so these are 2 possible scenarios for Keppel DC. Okay, then what's a safer price to buy Genting? Okay. Okay, Genting, recently it started to form a sideways pattern. Good thing is that price is still holding this 81.5 cents level, 82 cents level. In terms of the indicator, some pickup in terms of momentum, as well as MACD, we see a positive crossover. So I think if it doesn't end up in a bearish crossover downwards again, then maybe price could see some sideways consolidation for now. Yeah, but I don't expect very big move upwards. I think likely still very strong resistance close to 85 cents to about 86 cents level over here. So at most we could see some just range trading take place. Okay, then next up would be SIA. Yeah, okay, SIA is still continuing on its bearish momentum. So it's starting to trade a bit outside of this downtrend channel over here. And also another bearish signal is that actually it broke below the range consolidation, which was formed in May this year. So the support level of about 610 was broken. So maybe if this continues, the downwards momentum continues, we could possibly see a retest of the key support about 575 to about 580 level. I think this will be quite a stronger support where we could see maybe price start to sideways if it taps onto this level. And the next one is iFast. Okay, so for iFast, I think there's some bearish reversal taking place. So when price actually was trading in this uptrend channel over here, the momentum was actually very lacking in terms of in the indicators. And recently we have just seen a breakdown take place over here around 560. Yeah, so I think for iFast, the next support level will probably be around 530 if you base it on the Fibonacci level. Yeah, then the strong support, it comes down back, will be around close to $5 to $5.10 level, where it was a previous resistance. And then we have the 50% retracement level over here. Yeah, so for iFast, for now, I'm expecting price to just continue a downside momentum since there was just a fresh breakdown that took place towards the end of last week. Okay, then next up is Sheng Siong. Okay, Sheng Siong trading in the downtrend channel currently we're at the support which is around 146. So at this level is also a retest of the previous range resistance. Yeah, so if we are able to hold at this level, I think we just see perhaps a weak with a small rebound, maybe to trade sideways with resistance at 140 to 150. So this is for Sheng Siong. And then as for Propnex is also trading in downtrend channel over here. Price remains bearish, after breaking down some support levels at 86 cents as well as 83 cents. I think for now I think the downside could be stopped if there's some support close to 80 cents. So first one being the channel support, and then also we have 80 cents being a previous horizontal resistance. This was in February this year. Yeah. So yeah, at this level looks like quite a key previous horizontal resistance at the 78 cents to 80 cents area. So at this level, price could possibly just maybe just sideways if you find some support from that level. Okay, then for APAC Realty, also trading in downtrend channel. I think for this one, there could be some maybe price could go towards closer to about 47 cents to 48 cents. And there could be some support, swing low formed in October of last year. Yeah, and then this level, it also confirmed the channel support over here as well. Okay, let me see. Okay, next one is some Hong Kong counter. So 3032 HSI Management Tech Index ETF. It looks like price trading in this descending wedge over here still remains bearish, and we still see lower lows being formed, a breakdown of 372 about here. Yeah, so I think next support level close to 360. Yeah, 350 to 360, where is the 61.8% Fibonacci retracement level. When we take the lows formed in end October last year and the highs in January this year. And so possible we still see maybe a retest of this level where there's confluence of the Fibonacci level and the swing low from May this year. Okay, then for Tencent also currently at one support level, which is about 285 over there. So over here we have the trend line support, and then also when we look back in the past, this was a previous horizontal resistance level before there was a breakout and retest and price move higher afterwards. So this is a key level at 285. Yeah, so if price is hold at this level, I'm expecting some sort of rebound in the near term, but still likely to see resistance from this broken 296 level over here. And next one is 2318 Ping An Insurance. Okay, Ping An Insurance currently still bearish. We had low this formation over here, a retest of low the support close about 42 and a lower low formation, and price broke down to form a lower low. So with that, I think next support level to take note will probably be around 38.20 to about 39.40. This level, there might be some support for Ping An. Yeah, so I think a little bit more downside, then maybe we test this level. Let's see whether sub price starts to sideways or bounce a bit. Okay, then next up, Netflix. Yeah, so Netflix was originally trading a downtrend after downwards when bearish until the results came. Then currently we seen 2 days of sideways action. Yeah. For now the support is likely to be around 390. The intraday low over here, as well as previously we had this was a resistance level back then. So then for resistance wise, probably we'll see about 410 onwards to about 420 over here. So I think Netflix in terms of upside wise, it might meet some resistance if it goes to about 420. This week we have this downtrend resistance line, but in terms of the downside wise, probably 390 over there. There's still some support. Yeah, so I expect maybe some continued consolidation for this week at this range over here. Okay, then in terms of Google price, looks like price couldn't hold this 138 level, tried to break out, but looks like some price action failed to hold. Yeah, then in terms of the momentum indicators, it's still showing bearish divergence as price move up. So maybe price could come back to test about 133, 134 this level again. Yeah, then let's see, maybe sideways a bit, but there's earnings will coming out, so that will decide how the stock gonna move for the rest of this week. Okay, then next up, AMD. Okay, AMD looks like some short-term weakness after it failed to hold this short-term uptrend channel over here where it broke down 105. So currently price is sitting at around 100 to 101 level. Next support level will be close to $98. So but in terms of downside wise, I don't think there is much. I think likely we just see some sort of range consolidation, because that in terms of if price pull back further, we'll just be retesting this wedge breakout over here. So likely there's some support still at 98 to 99 level. So I think maybe price will just sideways, yeah, for this week. Okay, then next up, BYD. Okay, yeah, BYD. Okay, BYD, I think looks interesting. So price there was a possible breakout of this bullish flag over here, the price went up and retested the recent highs at 257 and some pullback. So for now, you need to see whether price actually holds this whole level over here as well as hold these 240 lows. So if there's a higher low being formed over here in this stretch, I think price could continue to rebound upwards and perhaps trade higher with this stretch of short-term uptrend. Yeah, so BYD is something I think it will be interesting to see how it holds this level. Okay, next one, Tesla. I think Tesla, interesting now. At 211, 212 this level, we actually retested this swing low from August. And I think when you use the Fibonacci level, when we take the lows created at the start of this year in January, and the swing high close about 300 from this year. There's also a 50% Fibonacci level coming at close to $200. And coincidentally, this level is also a previous resistance in March this year, where there's quite a strong resistance over here. And currently, this could turn into a support area over here. So in terms of downside wise for Tesla, I think this week might be, if it touches 200 to 210, this area, this zone, we could see some support. The previous resistance turns into support, as well as the Fibonacci retracement. Yeah, especially since we have seen quite a sharp drop since last week. Okay, then next one, NIO. I think for now, NIO, there's still some weakness in terms of momentum. The range support couldn't hold at 790. So I think likely we're going to see price try to retest about 730, 735, this swing low level. Then we see whether it's able to hold. Yeah. Okay, for Xiaomi, I think Xiaomi currently it looks okay. We had a trend upwards, a sideways range consolidation, and then it actually continued we had trend continuation take place. Currently, there's it's closing in on some resistance. So the zone is between about 1350 to about 1410. Yeah, this area we expect to see resistance upon the retest of a double top. Yeah, so for now, I think let's see whether it continues upwards. We try and test the higher end of this resistance area. Yeah, but for now, the uptrend is still looking okay. Okay, the next one, Bank of China. Okay, Bank of China, recently, I think we had a stretch, a possible trend reversal, in my opinion. So we had a stretch of lower highs over here as well as lower lows. But then price since September, price is consolidated and range, and there was a breakout over here. And currently price are pulling back to this about 274, 275 level. So if price is able to hold at this level, we would have seen a series of higher lows being formed. Then possibly we could make a higher high stretch, try and retest like 290s over here. Yeah, especially if this is a resistance turn support. I think for Bank of China, there's still hope for this stretch of uptrend to actually continue if there's some support along at these levels over here. Okay, so for JD, I think it's currently, it looks like it's the all-time low. So I really can't comment on the support level, but in terms of, yeah, trend-wise, it's definitely still very bearish as compared to the other Chinese tech. Yeah, for now, in terms of resistance wise, likely we're gonna see some resistance if it does retest 103, 102, 103 this level. The next one is Pi 2. Okay, Pi 2, I think also very strong downtrend momentum. Currently we are hitting a previous support around 104, 105 swing low from December last year. So possibly there could be a small bounce coming if it holds. Yeah, but I would expect just a small bounce since the selling momentum is actually very strong, and resistance likely to come in around 110 perhaps. But if it can't hold this level, likely we're gonna see price come to test like $98 as a next support level. The next one, China Mobile. The China Mobile, I think maybe we could see maybe price pullback further. Looks like in terms of MACD wise, it's increased very momentum, and this stretch of uptrend has been looks like it's entered with this consolidation taking place and a resistance cap at 66.30 over here. Yeah, so I think we could see maybe price go on to test like about 62.70 next. Yeah, previous resistance zone over here. Okay, then next one, the China Construction Bank. Okay, I think for now, the uptrend looks like it's still intact. Just with some pullback from 470 resistance. So important to see the higher low try to being formed. Try to form perhaps let's see only 445 or 450 area this resistance. If you do retest, then hopefully there's some support coming in. Okay, then for Yangtze Shipbuilding, currently we are retesting about this 139 level previous resistance breakout. This could act as support for now. Yeah, and then we also quite close to this very long term. Okay, not say very long term. So since last year March we have this uptrend support so as well. So I think in terms of downside wise, probably limited. Yeah, then perhaps if there's some support, we could see some short term bounce for Yangtze near term. Okay, then for Suntech REIT. Yeah, Suntech REIT looks like it's still continuing downwards. Yeah, lower low being formed. So with that, yeah, I think downtrend is still continuing on. Perhaps you could see maybe a retest of some previous support levels at around 140 to about 108 to about 111 zone. Yeah. Okay, I just take a few more. I think we are close to one. So 9988 Alibaba. Okay, Alibaba. Okay. It looks like price is still unable to hold this after a range consolidation over here between 81 to about 86. Yeah, it looks like possible breakdown coming in again. So I think we could see maybe price test the lower support of about this is 76 or 78. Yeah, this area. Yeah, so it looks like another continuation of the previous downward movement for Alibaba. Okay, then I'll talk about the Singapore 3 local banks. Okay, and DBS just sideways currently at this support level at around 33. I think there's a lack of momentum actually in terms of indicators. So I think at this level, if we do see, there could be some bounce coming in, but I think it's still bearish, especially if we can't get above this, get back to this channel, uptrend channel, then maybe we could see low week form to try and maybe test like 32.40 this next swing low. And then for UOB, yeah, UOB also currently tapped onto this 2770 support level. There was a recent breakdown of this range consolidation as well. So it looks like possible continuation of some bearish momentum. So I think similarly there's also a weak momentum. Yeah, so could maybe see test of lower support level between 2740 or 2750 if the recent lows cannot hold. Okay, then last one for OCBC. Also, if OCBC also couldn't maintain this 1290 level breakout over here, then it looks like we might see a retest of this uptrend support line. Yeah, might bring us down to 12, close to about 1260s. Yeah. So let's see whether this is able to hold for OCBC. So yeah, I think that's all for me now. I'll hand back the time to my colleagues if they have any more questions to answer. Thanks.
Yeah, I think we still got some questions. I'm not sure we have time to answer everything. Do you want to take some, Darren, if you want to?
Yeah, I'll answer some quick one. MLT, FLCT continue to find bottom with Fed rates higher for longer. What are their respective TP? Yeah, so sorry about that. We do not cover these two counters, so we do not have a TP. Yeah, but for REITs, yeah, the share price we still believe will maintain quite flattish or sluggish in the near term because of this higher for longer. But we are in it for the dividend play. Yeah, and the forward dividend yields are already more than the 10-year average. So we like it, as well as the price to NAV is also trading at attractive valuations. Yeah, so that's a quick answer. Yeah, thanks. Of the 3 US-based REIT, which are the ones still worthy of investing in your view? Can you rank them accordingly? I mean, definitely I got a view, but I think I prefer not to rank them out in the open like that. But for US REITs, we believe the recovery will be towards the end of 2024, and because they are trading at all so cheap valuations, right? Once this sentiment turn, right, and we will never know when the sentiment will turn, right? The share price correction will be very steep as well, very sharp recovery in our view. But maybe not so quickly in the near term because there are still some headwinds going forward. Yeah, and Manulife ES REIT, yeah, no updates for now. But we do have a webinar with them on the 3rd of November. Yeah, so please sign up. Feel free to sign up. Yeah. And one more, since interest rate is expected to be high for longer, why can't REITs simply increase the rent to boost their revenue? Yeah, so the REITs can't do that because the tenants will have a lot of pushback, and if let's say if there are many competitors in the market, if you decide to raise rents and then the tenant will just leave and go somewhere else. Yeah, so it's still a demand supply thing. Yeah. Yeah, so they just can't just raise rents for the sake of increasing revenue. Yeah. Okay, so hope that answers. I think I'll pass on this to my colleagues. Oh, and on Dasin, are they just going soft? Yeah, Dasin, they defaulted on their loan. So once you default on the loans and unable to make payments, yeah, it's hard to see them recovering unless they somehow manage to pay off the loans that they defaulted on. Yeah, but from this current situation, quite unlikely. Yeah, okay. Hand back to you, Paul. Thanks.
Yeah. Any for... Oh, sorry, Peggy, go ahead.
Okay, there's a question on C-Stream, so maybe I do that. any potential for Seatrium to have a share merger to leave it beyond the penny stock status for institutional players? This is a question we ask them many times. I mean, all analysts ask them at the briefing as well. They say it's one of the items that is under consideration as they do their review of with the merger of KOM. So there's a possibility that this might take place. Yeah, but no confirmation so far. The second question for me is, Peggy, further to your view on aviation business in China, can you share your view on Shanghai International Airport and Beijing Airport? I'm not an expert in these two companies. I'm just covering them for the sake of covering China Aviation Oil. But the Beijing Airport is, after the passing airport came up, this Beijing, I think you're referring to 694 Hong Kong, right? Beijing Airport doesn't own the Passing Airport, so Passing has already been taking over the passengers from this Beijing Capital Airport. So Beijing Capital Airport was top airport in China in 2019. It's dropped to number 11 in 2022. So this says something about that stock. Shanghai International Airport, of course, owns the Pudong and Hongqiao Airport, so it's benefiting from the recovery in passengers. But having said that, along the whole aviation food chain, I think airports it's probably the last one you should consider to invest in because of a high capex, high capital expenditure, high investment that they put into the construction of the airports. And most of the income comes from actually more from concession revenue and rental income from the stores, from the shops. So it's really a play on the property sector. So the fixed cost is, as a percentage of total cost, is very high. But for airlines, the fixed cost is lower. Is probably about maybe about 65% of the airlines operating cost. So it's relatively lower than the airport. So as flights come back, airlines are able to capture more of the gain in terms of in their bottom line. So I hope I answered that question. I'll put a note in P3 if I have more if I have some answers from I'm talking if I have some more views on these two companies. Thank you. I think I hand back to you, Paul. Thanks.
Oh, okay, thanks, Peggy. Okay, I'll just wrap up. Try as many as I can to wrap it up. Any update on Manulife? So the what they're trying to do now is to negotiate with the banks and just to future-proof their refinancing, because it's not just about 1 year; it's the next 2 to 3 years. So that's why it will take time, because it's going to involve all the banks. The one positive, apart from, I guess, recently they announced renewal of a tenant, is that early September or mid-September, I think the Manulife, actually one of the directors is the head of real estate in the Manulife parent sponsor. So I guess it's one signal that investors look at as the commitment of the sponsor, because this is all going to be reliant on the sponsor. So because you're not pricing on rental recovery, you're just pricing on this company, on Manulife. No, I guess like Manulife, there's no default and so forth. So having the Manulife parent placing in their head of global real estate into the board is also another positive signal. Your thoughts on Yangzhejiang Shipping and Yangzhejiang Finance? I think maybe Peggy talked about Yangzhejiang Finance, Shipping, but I guess for finance, I think we highlighted many times before. I think the next 2 to 3 years earnings is just going to be weak, because like I said, they're taking their revenue from China, which is earning attractive loan yield, and then transferring the money out to Singapore to earn private equity returns, which obviously is going to take a long time. And you're only positive if you do a positive carrier. That means you do a return. You sell and you earn some positive return on it. So I think the earnings is still going to be quite weak for Yangzhejiang Financial, regardless of the recent announcements. Any update on Olam? it's all about the IPO of Olam Agri, which is supposed to be first half of 23, then shifted to June, then now deferred indefinitely. I think the most important thing is like under what conditions will Olam Agri listing be conducive? I think it's going to be tough because Olam was hurt, it's hit a lot by their financing costs. So I think this is only any listing is maybe only probably next year. I don't know, maybe there was some diplomat visit by Saudi Arabia, maybe that helps because this is Olam Agri. The valuation of them on paper is about 3.3 billion US. So it's equivalent to the whole Olam listing. But I don't think any listing because the market is not conducive to go and do a listing. And then once you're hitting fourth quarter already. So I think they probably need to use December year-end accounts. So by then you're probably talking about any listing is probably June of next year. My own guess. Okay, I think one last one, LHN, any upside? So for LHN, I think it continue to be earnings growth because their co-living the occupancy continues to climb and the rentals continue to rise. And of course, there'll be special dividend as they recently sell off LHN Logistics. So these are the upsides for it. Okay, sorry to drag. I think it's already like 2 hours. So any other questions, we try and post it in P3 community. And thanks everyone for your time and for taking on so many of you and for posting so many questions. We try to answer as many as we can. We answer like 50 plus, but we can't answer everything. So sorry for that. But again, thanks everyone for your time and have a good week ahead. And thanks for dialing in, everyone. Take care and have a good week ahead. Bye-bye.